Hello and welcome to Unacademy, India's largest online learning platform, which provides you a world of courses, resources, and content to choose from to help you in your preparation with the various examinations. So, crack CA exams with us is a vertical started by Unacademy, which caters to the students of the CA foundation, intermediate, and final level to help them in their preparation and crack the CA exams. So, let's crack CA exams. A little about the educator today. Hello, I am Prathik Gupta. I am a Bachelor of Commerce from Christ College, Bangalore University. I am an associate member of the Institute of Chartered Accountants of India. I am also an associate member of the Institute of Company Secretaries of India and an associate member of the Institute of Cost Accountants of India. Along with this, I am also a law graduate from Karnataka State Law University and currently a practicing chartered accountant. I am also a visiting faculty for CA students and an educator for CA students both online and offline. Prior to starting my own practice, I worked with SR Bartley and Associates, that is the Indian member firm of Ernst & Young Global in the Audit and Assurance Department and Ernst & Young India in the Mergers and Acquisition Department. I have also worked with the Manipal Group as the corporate controller of their Indian and German entity located in Frankfurt, Germany. I got back from there and that's when I decided to start on my own. Welcome to my session. Like I said, Unacademy is the largest online learning platform that opens your doors to a world of courses, resources, and contents that Unacademy has to provide to you in terms of preparation for your various examinations and also to follow the subjects and topics of your choice and interests. The Unacademy platform has a plus subscription platform, which is a paid model and a paid subscription model, which provides you the following benefits if you become a member of the Plus program of Unacademy. Firstly, it provides daily classes where you get to chat with your educator, engage in discussions, ask your doubts, and answer polls. Yes, all this while the class is going on. So what happens with your daily life classes? You get to choose your educator, your favorite educator, your topic of your choice, and also the timing of your choice. And then as and when you go through the course, to go through the session, if you have doubts or if there is anything you want to discuss, you are free to discuss it then and there. You are free to clear your doubts then and there with the educator, and your educator will be more than happy to clear your doubts on the spot. All this while the class is going on. You do not need to fix an appointment or wait for another day or schedule a doubt clearing session, but all this can be done real time when the class is going on. Also, the Plus platform of Unacademy provides you various live tests and quizzes which help you in your preparation by evaluating your preparation with the regular mock tests and quizzes and get detailed analysis on your performance. So what do these live tests and quizzes do? These live tests and quizzes help you understand your level of preparation, help you understand your areas of strength and your areas of weakness so that you can focus more and spend more time on your areas of weakness and spend lesser time on your strength areas and compensate that time on your weak areas so that your weak areas also become your strong areas. So that's how these mock tests and quizzes, which are conducted very regularly and frequently, help you with your performance. The courses provided by the Plus platform of Unacademy are structured courses. They are structured in the sense that they are in line with your exam syllabus, whatever the examinations you are choosing. They are in line with your exam syllabus and help you best prepare for it, and to the maximum extent possible, ensure that you do not miss out anything important or substantial while preparing for your examination, as the entire syllabus or most of the syllabus is covered. I would say all the syllabus is covered. All right. And then lastly and most importantly, the subscription to the Plus platform of Unacademy provides you access to all the live and recorded courses to watch from the comfort of any device. So what it does, once you subscribe to the Plus platform of Unacademy, you get access to all the live and recorded courses by your favorite educators who are world-class and expert educators in this domain. So you can listen to them, you can listen to their live lectures, you can also listen to their recorded lectures going into the archives, and all this you can do it at the comfort of your house by using your desktop, your laptop, your tablet, or your mobile phone, and in the convenience of your room. And at the click of a button, you can access all these at any time. You do not need to fix a time and this information is available to you 24/7 and whenever you want it. So I hope you will make use of this Plus platform of Unacademy and take advantage of all these opportunities. I strongly recommend you to be part of the Plus Academy Plus subscription program of Unacademy. I hope to see you there soon. For those of you who have downloaded the Unacademy Learning app and are using it, I thank you very much, and I request you for your continued support in future as well. For the ones who have not yet downloaded the Unacademy app, I request you to download the Unacademy app from your Play Store and register on it using your mobile number, on which an OTP will be sent, and then you can register on that Unacademy app using that OTP. So it's as simple as that. So what happens once you register and start using the Unacademy Learning app? It opens the gateway to the world of courses, resources, and contents that Unacademy has to offer you. And yes, all this at the tip of your fingertips, whenever you want it and whatever and wherever you want it. Whether you are in between meetings, whether you are rushing somewhere and you are commuting and you have no time, you can access all these contents on the go. You do not need to be in your room to access this. You do not need to be in front of your desktop to do it. You can do it whenever you want, and all you need is a data connection on your phone, and which is quite common these days. So it helps you prepare on the go in a world today where everyone is running busy and helter-skelter. So again, for those of you who are already a part of Unacademy app, thank you so much. And for the ones who have not yet downloaded the app and not using it, I request you to download the app from the Play Store and register on it using the OTP. Like I said, the Unacademy Plus program is a subscription-based model which opens your gateway to the world of courses, resources, and content, live and recorded, of Unacademy. So I am part of the CA Foundation and Intermediate subscription. So the packages in the CA Foundation and Intermediate Plus subscription are, the packages are for 1 month, 3 months, 6 months, 12 months, and 24 months. The 1 month package costs you rupees 3,500. The 3 month package costs you rupees 8,750. The 6 month package costs you rupees 14,000. The 12 month package costs you rupees 17,500. And the 24 months package costs you rupees 18,000, rupees 21,000. Now, while you're free to make a choice of the subscription package you want, that is either 1 month, 3 months, 6 months, 12 months, or 24 months, I would strongly recommend to you to go for the 12 month or the 24 month package for 2 reasons. First being, it is cost effective. If you see the costs of the 3 months, 6 months, 12 month, 24 month package, it's not much different, but the duration increases substantially. So it's cost effective. And when you prepare for a course like CA Foundation and Intermediate, you normally require a year or more to prepare for these examinations. And both the foundation and the intermediate package is being provided to you in one subscription. And normally the time taken between a foundation exam and intermediate examination is a year. So the 12 month package or the 24 months package will make more sense for you to take. Having said this, it is your choice. Whatever package you want to choose, you are free to choose it. But please do not forget that when you're making the choice of your package, please do not forget to use the code Prathik, Prathik, to get a discount of 10% on the listed price of the package. I repeat, Prathik, to get a discount of 10%. So the after discount cost of the subscription packages are, the 1 month package costs you rupees 3,150. The 3 month package costs you rupees 7,875. The 6 month package costs you rupees 12,600. The 12 month package costs you rupees 15,750. 24 months package costs you rupees 18,900. So please remember to use the code Prathik, Prathik, to get a discount of 10% on your CA Foundation and Intermediate subscription of the Unacademy Plus program. I hope you will find the Plus program very useful, and I strongly recommend you to be a part of it and come on board as soon as possible. And I hope to see you there soon. And for those of you who have missed my earlier sessions, let me bring to your attention that I have conducted various sessions on the Companies Act 2013 for the CA intermediate level as well as the CA foundation level. For the intermediate level, I've conducted sessions on incorporation of a company and matters related thereto, where I have spoken about the types of companies, that is private limited, public limited, OPC, one-person company, Section 8 company, the mode of incorporating these companies, and the 2 important documents in a company, that is the Memorandum of Association and the Articles of Association. Then I have discussed about, the next topic is about Prospectus and Allotment, which is applicable to public companies who can invite public to subscribe to shares of their company with the help of a prospectus, which is nothing else but an advertisement inviting the public to subscribe for their shares. And then the allotment is when the shares are allotted or assigned to a particular applicant. Then that's called allotment. Then the next session I've taken is on share capital and debentures. Please remember, a company, private limited, public limited, or OPC company has different kinds of share capital. That is equity share capital, who are the owners of the company, and preference share capital, who have a preference over the payment of dividend and the repayment at the time of winding up over and above the equity shareholders, and that is why they are known as preference shareholders. Then there is debentures, which is a kind of a security, and that's why it is called security and not a share. So what are the provisions, what are the different type of debentures, equity shares, all that was discussed in that session. Then the next session I took on acceptance of deposits. Like a company issues equity shares and preference shares and debentures to raise capital, another method in which the company can raise capital is through deposits. Just like a bank accepts deposits for the purpose of lending, a company also can accept deposits, but not for the purpose of lending, but for the purpose of usage in its business, in return for which it pays interest, and it is for a definite period. The maximum period for which a deposit can be accepted is 36 months, and the minimum period is 6 months. And then I took a session on payment of dividend. The payment of dividend is that is the return that is normally expected by preference shareholders and equity shareholders. Just like interest is paid to loan, dividend is paid on preference share capital or equity share capital. So what are the nuances and nuances? What are the nitty-gritties of dividends, the procedures for dividends to be paid? All that was discussed in my session. You can please go through these sessions in the archive, and also in the archive I have taken sessions on Companies Act Part 1 to 6, which is there on YouTube. You can refer these sessions, and also there are various other sessions taken on Companies Act. So I request all of you to access these sessions and benefit from them, and ask me if you have any doubts. Also, for the people who have not yet followed my profile on the Unacademy app, I request you to go to the Unacademy app, go to my profile, Prathik Gupta, and click the follow button so that you get real-time updates about the sessions, the topics of the same, and the timings of the same, so that you are never late for my sessions and can attend my sessions always on time. Once again, I repeat, please do not forget to use the code Prathik, Prathik, to get a discount of 10% on the listed price. Please take about a minute and go through this slide where you have the packages for the subscription model, and then we proceed. Okay, so today what we're going to talk about is accounts of companies. Before I go into the session, I would like to give you a brief introduction about what we're going to talk about today and how is it related. Now, like every assessee or like every individual who carries on any business activity or any commercial activity, the maintenance of accounts becomes a very important topic and an important component of that, because if you do not maintain your accounts, you will never know from whom you're supposed to receive money, from whom you're supposed to give money, what is the sales you've made, what are the purchases you've made, how much of capital you have, how much of loans you've taken, what are the various government compliances you need to do. I mean, it's too difficult for a person to remember this offhand. So you need to maintain your accounts. And sometimes some entities like proprietorship and partnership, the format or the form in which you maintain your accounts is not given. But in terms of companies which are formed under the Companies Act 2013, the format of maintaining your accounts or how you should be doing that is always mentioned, and a company is required to maintain the accounts as per that format and as per the requirements of the Companies Act 2013. Earlier to Companies Act 2013, we had the Companies Act 1956, and earlier that we also had another Companies Act. So all the companies that are formed under the earlier act, under Companies Act 1956 or the Companies Act 2013, are required to maintain accounts as per the Companies Act, respective Companies Act under which they were incorporated. So today we will talk about the various accounting requirements of companies, the maintenance of books of accounts, where they have to maintain the books of accounts, when they have to maintain it, and for what period they need to maintain the books of accounts. All these things we will talk about in today's session. So in case anyone has any doubts during any part of the session, please ask me and I will be happy to answer it. Okay. Introduction. Now, there is a need for disclosing the annual information to the shareholders by the directors about the working and financial position of the company so that the shareholders are aware of the affairs of the company. The Companies Act 2013 lays down various provisions relating to maintenance of proper books of accounts and companies. Alright, so now please remember who runs a company. A company is run by a board of directors who are elected by the shareholders. So the actual owners of the company are shareholders, but because of the possible number of shareholders, it may not be possible for each shareholder to run the company. So directors are elected by the shareholders to act as their representatives and run the company. So if the responsibility of running the company is given on the directors, then that makes the directors also responsible and accountable to the shareholders. Now, in order to show their accountability and responsibility to the shareholders, a part of it is also to prepare the accounts of the company and give to the shareholders a statement showing the financial position of the company and the affairs of the company so that the shareholders are aware of it, because the directors are the ones who carry on the day-to-day operations of the company and not the shareholders. The shareholders do not do it. The shareholders possibly meet only once a year during the annual general meeting or if there is an extraordinary general meeting. But whereas the directors are the ones who carry on the day-to-day running of the company. All right, and that for this purpose, every director or every board of directors is supposed to give the annual information to the shareholders to show the financial position and the affairs of the company to the shareholders. This is what we're going to discuss about in today's session. Okay, now books of accounts to be kept by company. The Companies Act 2013 specifies certain minimum books of accounts that need to be maintained by each company. This is important because those specific minimum requirement of books will show the true and fair affairs of the company. So general requirement, every company shall prepare a books of accounts and other relevant books and records and financial statement for every financial year. These books of accounts should give a true and fair view of the state of affairs of the company, including that of its branch offices. These books of accounts must be kept on accrual basis and according to double entry system of accounting. We will talk about this. Now, what are the various financial statements of a company? The financial statements are the balance sheet, the profit and loss account, the notes to accounts, and the cash flow statement, which is applicable to certain classes of companies depending on their size. That we will discuss further. So every company shall prepare a books of accounts. The books of accounts are prescribed by the Companies Act, which also we shall see in the following slides, and the records and financial statement for every year. So every company is expected to prepare a balance sheet, a profit and loss account, notes to accounts, and cash flow statement for every financial year. Financial year is a year starting from 1st April 2019 to 31st March 2020. So that's a financial year. Then the next requirement is these books should give a true and fair view of the affairs of the company. Now, if you read this sentence carefully, it says these books should give a true and fair view of the affairs of the company. Now, who will decide whether these books give you a true and fair view of the affairs of the company? That is where the audit comes in. A statutory audit or a company audit is done every year by a person known as an auditor who checks whether the books of accounts maintained by the company and the financial statements prepared by the company give a true and fair view on the state of affairs of the company, and he gives an audit report for that. And this also includes the branch office. Let's say the company has a head office and it has various branch offices. So all of them will be clubbed into one, all the accounts will be clubbed into one set, and one financial statement will be prepared for the company and all its branches together. And then the auditor will give his opinion whether the books of accounts show a true and fair view of the affairs of the company. These books of accounts must be kept on accrual basis and according to double entry system of accounting. Now, please remember, this is a very important concept. There are two concepts mentioned in the sentence. One is an accrual basis and one is double entry system of accounting. What do you mean by accrual basis? Can anyone answer me what is accrual basis? Accrual basis means as and when it occurs. There are two ways of maintaining your accounts. One is cash basis and one is accrual basis. Cash basis means whenever cash comes in or whenever cash goes out, a transaction is recorded then. But an accrual basis is whenever the transaction takes place irrespective of when the cash comes in or cash goes out, is the accrual basis. Let's take an example. Now you need to know these concepts very well because this will help you in your accounts as well. Now let's take, for example, you buy something from a person and you immediately pay him cash. Let's say you buy a book and you pay him 100 rupees as cash. So the transaction and the cash payment has happened then and there. But let's say if you buy a book and you pay him after a month. Now according to cash basis, you will not record the transactions, agreed? But as per accrual basis, you are required to record the transaction. Why? Because the transaction took place today. The accrual basis is on as and when it happens basis. So you will record the transaction that the book was purchased today. Even though the payment is to be made after 1 month, you will write in your books that this book is purchased on credit and the vendor has to be paid after a month. And after a month, when you pay him the money, you will say cash paid to the vendor. So the transaction is recorded today. The payment entry is recorded whenever the payment happens. But in a cash system, you will record the entry only when you make the payment or receive the payment. Similarly, if you sell a product to your customer for rupees 5 lakhs and the customer pays it to you after 3 months, in an accrual basis, you will still enter the entry today that a sale was made on credit, even though the money you are receiving it after 3 months. All right. So there are two ways of recording it on accrual basis. First thing is you'll record the credit sale, and next thing is whenever the money is received from the customer, you will record the transaction that time. So it's not on cash basis, as cash basis may not always give you the accurate results of a company, and the credit transactions are not really recorded. This is okay if both the transactions, that is the sale and purchase and the receipt of money, happens in the same period. But what if the sale or purchase happens in one period and the receipt of money happens in another period, financial year? So that is where accrual basis of accounting comes in handy, and you need to do it that way. All right. Now the second concept is double entry system of accounting. Double entry system of accounting is also very important. Why? Because double entry system of accounting follows the rule that every transaction has 2 entries, or it affects 2 ledger accounts. So for example, if you've received money from A, you will debit, or you will credit A's account and debit the bank account. So example, the entry will be bank account debit to A. So bank account is involved as well as A's account is involved. So when you prepare the ledgers, you will prepare 2 ledgers. One is A's ledger and one is bank account ledger. So one entry, one transaction will be entered in 2 places. That is the meaning of double entry system. All corporates, all business associates today use the double entry system of accounting and the accrual system of accounting, as these give you the more accurate results. Okay, so let's read. Accrual basis of accounting is an accounting assumption or accounting concept followed in preparation of financial statement. Accrual concept is one of the 4 principles of accounting concept, which involves recording of income and expenses as they accrue. That means as they arise, distinct from when they received or paid. Please take about a minute, go through this slide, and then we proceed. Okay, yeah. Double entry bookkeeping is a method of recording any transaction of a business in a set of accounts in which every transaction has a dual aspect of debit and credit, and therefore needs to be recorded in at least 2 accounts. Like I told you, cash and bank and A. Double aspect enables effective control of business because all the books of accounts must balance. Books of account, okay, now the books of accounts are being the minimum books of accounts that need to be maintained by a company under the Companies Act 2013 are as follows. Section 2, subsection 13 includes records maintained in respect of all sums of money received and expended by the companies and matters in relation to the receipts and expenditure taking place. So if the company receives any money or spends any money or any receipt or expenditure, it should maintain a separate books of accounts for each item, that is money received, money expended, receipts and expenditure. It should maintain separate books of accounts. Sales, purchase of goods and services of the company. For sales, it should maintain a separate account, a sales register or a sales book. And for purchases, it should maintain a different register or a book, sales book. The assets and liabilities of a company. For the assets, it should have a different book, and for liabilities, it should have a different book. The assets such as fixed assets, that is furniture, computer, building, vehicles. Then you have your sundry debtors, that means the money you're supposed to receive from people, the advances you have paid, the prepaid expenses you have paid, the inventories you have. All these will be as assets. Liabilities will be the share capital, the loans taken from banks or other people, the sundry creditors, that is the people who you need to make payments, the advances taken from customers. All these are liabilities, so these have to be maintained in a separate book. The items of cost as may be prescribed under Section 148 of the Companies Act in the case of a company belongs to any item. So in case a cost audit, especially for manufacturing companies, in case a cost audit or this thing is applicable to a company under Section 148, then those additional books of accounts to determine the cost will also have to be maintained by that company. Book and paper or book and book or paper as defined under Section 212 include books of accounts, deeds, vouchers, writings, documents, minutes, and registered maintained on paper or in electronic form. So with the advent of computers and electronic media, now the accounts and everything are maintained on computers and laptops and this thing. But maybe a few years ago, it was all maintained on paper and ledgers, manual ledgers. So books of accounts could be either manually written or it could be in electronic form. Both are acceptable. Okay, I request you to take 2 minutes and read the slide as to the books of accounts and book and paper, and then we proceed. Take about 2 minutes, go through the slide, and then we proceed. Take another minute. Okay, the place of keeping books of accounts. Section 128(1) of the Companies Act requires every company to prepare and keep the books of accounts and other relevant books and papers and financial statements at a registered office. Provided all or any of the books may be kept at such other place in India as the board of directors may decide. Where such a decision is taken by a board, the company shall within 7 days file with the registrar in notice or in writing giving full address of that place. So normally the books of accounts, that is your previous slide, what you saw, sales, purchase, expenses, incomes, assets, liabilities, and the cost records should be maintained mandatorily at the registered office of the company. The registered office of the company is nothing else but the office, which is the address which is there in the certificate of incorporation of the company and mentioned as its registered office. But a company may also maintain these books of accounts in other places, provided it gives a notice within 7 days to the registrar of that additional address of that place. Maintenance of books in electronic form. A company has an option of keeping books of accounts or other relevant papers in electronic mode as per Rule 3 of the Company's Account Rules 2014. Rule 3 lays down the manner of books of the accounts to be kept in electronic mode. So like I told you earlier, maybe a few years earlier when the accounts used to be maintained in physical or book mode, that time it was written in ledgers and things like that. But now with the advent of computers and technology, accounts can be maintained in electronic form or in electronic media through computers, tablets, or laptops. Such books of accounts or other relevant books or papers maintained in electronic mode shall be remain accessible in India so as to be usable for subsequent reference. Just like ledger books and physical books are required to be checked, this thing, even the accounts maintained in electronic form have to be reachable and accessible for use for subsequent reference. Please take about a minute, go through the slide, and then we proceed. Take about 30 seconds more or 1 minute more, go through the slide, and then we proceed. Okay. Now, the information contained in the records shall be retained completely in the format in which they were originally generated, sent or received, or in the format in which present accurately the information generated, sent or received, and information contained in electronic records shall remain complete and unaltered. So, needless to say, whenever information is, whether it is in a ledger, it's in ledger book, physical mode, or electronic mode, it should always remain unaltered and remain in the original format in which the information was created. This is because altered or modified accounts may not give you the true and fair view of the affairs of the company. So it's always encouraged that the accounts are not altered with or tampered with, and they should be in the original form and generated consistently year on year in the same format. The information received from branch offices shall not be altered and shall be kept in a manner in which they depict what was originally received from the branches. So in order to do this, you also need to tell your branches that the same format that is being used for the head office, you also need to provide me the information on the accounts in the same format, so that both of them can be clubbed and the information can be provided to people collectively. All right, and needless to say, it should not be altered or tampered. The information electronic record of the document shall be capable of being displayed in a legible form. Even if the accounts are maintained in an electronic format, they should be capable of being displayed in the form of a balance sheet, P&L, trial balance, cash flow, and this thing. So you should be able to make meaningful sense out of the information being provided in a electronic form, and it should not just be a dump of information and leave it to the reader to make sense out of it. It should be provided in a meaningful and purposeful manner. The backup of the books of accounts and other books and papers of the company maintained in electronic mode, including at a place outside India, if any, shall be kept in servers physically located in India on a periodic basis. Let's say now obviously, see, now with when you had information in physical mode, the danger was that if someone is going to steal it and it's going to get burnt or it's going to get damaged. The similar thing applies to even data that is maintained in electronic form, as it can also always get tampered with, it can always get attacked by viruses, it can always get robbed, or your system can crash. So the backup of that data or the servers containing those data should always be kept in India, for the simple reason that if anyone wants to access that information, he can access it. A copy of that information can be kept abroad, but the servers and the main backups should all be kept in a place in India, so that it is accessible to all the people. Please take about a minute, go through this slide, then we proceed. Take about 30 seconds more, go through this slide, and then we proceed. The company shall intimate to the registrar on an annual basis at the time of filing of financial statement following relevant information related to service provider: the name of the service provider, the internet protocol address of the service provider, the location of the service provider, the books of accounts and other books and papers maintained on cloud, such address provided. In case your accounts are maintained by an external party and it's maintained on cloud or on external servers of consultants or external parties, you will have to inform the registrar of companies about who is that third party vendor and what is the IP address, what is the name of the service provider, where the information is maintained on his server or on the cloud, so that even the ROC knows and everyone knows that where your information is provided and it is accessible. And tomorrow if the ROC wants some information, they can derive that information from there. Books of account of branch office. Now we'll discuss about how the books of accounts of branches are maintained and prepared. Where a company has a branch office in or outside India, it shall deem to have complied with the provisions of subsection of the transactions effected at the branch office are kept at that office, and proper summarized returns periodically are sent by the branch office to the company at its registered office. Okay, so and are kept for inspection at the registered office of the company or at such other place in India by any director during business hours. Now, this simply means whenever you have branches in India or abroad, the accounts have to be prepared in India because the main head office is in India and the branches are abroad. It could be in India or it could be a place outside India. So normally what happens is the information provided by the branches should also be in the same format as that of the head office, and care should be taken that this is done. Okay, if this has to be done because then the accounts of the branch and the accounts of the head office have to be merged, and if the accounts are provided in different formats, then it will become a difficult task. So also the accounts provided by the branch should be kept open for inspection at the main office or the registered office of the company or any other place in India by any director during business hours. So the head office accounts, the branch office accounts, the merged accounts, all of them should be kept open at the registered office of the company or such other place in India or otherwise by any director during business hours. Now, inspection by directors. As per section 128(3), any director can inspect the books of accounts and other books or papers of the company during business hours. Such inspection may be done by any type of director, that is, nominee, independent, a promoter, or whole time. The provision of subsection 3 provides that a person can inspect the books of accounts of the subsidiary only on authorization by way of resolution by directors. So, what are the books of accounts we saw so far? The sales book, purchase book, expense book, income book, assets book, liability book, and then the books of the branches as well. All of these have to be maintained ordinarily at the head office of the company, and it should be open for inspection by any director during the business hours of the company. And such inspection may be done by any director, which could be a nominee director. A nominee director is a director normally when you take a loan or you take an investment from another company, and then those companies put a director on your board to ensure that the money is being utilized properly. So they are a nominee of those companies who invest in your company. An independent director is a director who is not interested with the day-to-day affairs of the company or who has no interest in the company other than being a director, and he is basically hired for his expertise. A promoter is a person who starts the company or does the work in starting off the company, and he's normally interested in the day-to-day affairs of the company. Or a whole-time director is the managing director or a person who is interested in the affairs or day-to-day affairs of the company. The provision to subsection 3 provides that a person can inspect the books of accounts of a subsidiary only on authorization by a board of directors. Now, if you have a subsidiary, if the company has another subsidiary company, then the books of accounts of that subsidiary can be inspected only on authorization by way of a resolution of the board and not otherwise. Please take 2 minutes, go through this slide, and then we proceed. Take another 2 minutes, go through this. This is basically the books of accounts of branch office and the inspection by directors. Take another minute. Okay. Now, the period for preservation of books. Now we talk about how long that the books of accounts of a company have to be preserved or maintained by the company. The books of accounts of every company relating to a period of not less than 8 financial years immediately preceding the financial year, or where the company has been in existence for less than 8 years, in respect of all the preceding years, together with vouchers relevant to the entry in such books of accounts, shall be kept in good order. The provisions of the Income Tax Act shall also be complied with in this regard. Now, let's say the books of accounts are being prepared for the financial year 1920, that is from 1st April 2019 to 31st March 2020. In this case, the previous 8 years before this financial year, the books of accounts have to be kept in handy, and also the vouchers and the supporting invoices for each entry in those books of accounts have to be preserved for a period of 8 years. I repeat, 8 years. And in case a company is less than 8 years old, then in that case, from the time it started till the current financial year, it has to keep the books of accounts, all the books of accounts. Okay, so normally the books of accounts of any company needs to be retained for a period of 8 years. And also the provision of Income Tax Act shall be applicable or complied with this regard. Even the now why this is mentioned here is, as per the Income Tax Act, also they can open your books of accounts or assessment for a period of, I think, 6 years. So that also needs to be maintained. So it's not like one financial year is over, so you throw away the books of accounts. No, you have to keep it in existence for 8 financial years. Persons responsible to maintain the books, as per section 128(6), the person responsible to take all reasonable steps to ensure compliance by the company with the requirement of maintenance of accounts should be the managing director, the whole-time director in charge of finance, the chief financial officer, any other person named by the board with the duty of complying with the provision. So a managing director is the director who is responsible for the day-to-day affairs of the company. A whole-time director is also similar to a managing director who's in charge of the day-to-day managing of the affairs of the company. The chief financial officer is the head in the finance domain, and normally companies do not vest this with the managing or whole-time director, but they vest this responsibility with the chief financial officer, who's also known as the CFO. So he will be responsible for maintaining the books of accounts, getting them accounts prepared, getting them audited, or any other person of a company charged with the board with the duty of complying with the provisions. So what this means, the board may authorize any other person to comply with these provisions. Please take 2 minutes, go through the slide, and then we proceed. Take 2 minutes, go through this. And then we proceed. So here we talk about the period of preservation of books and the persons responsible for maintaining the books. Take another minute. If you have any questions, please ask me. Okay. Now, what are the penal provisions? In case the aforementioned persons referred to in subsection 6 fail to take reasonable steps to secure compliance, they shall in respect of each offence be punishable with imprisonment for a term which may extend to 1 year, or with fine which may not be less than rupees 50,000 but which may extend to rupees 5 lakhs, or both. So the following persons, that is the managing director, whole-time director, chief financial officer, or any other person, if they do not take care of the responsibility of maintaining the accounts, they shall be punishable with imprisonment for a term which may extend to 1 year, or with fine of rupees 50,000 rupees which may extend to 5 lakh rupees, or both. Now let's take an example. ABC Limited wants to maintain its books of accounts on cash basis. Is this a valid act of ABC Limited? The Companies Act 2013 wide section 128(1) requires every company to prepare books of accounts and other relevant books and papers and financial statements for every financial year on accrual basis and double entry system of accounting. No exceptions have been given by the Act to any class of companies from the above requirement. Hence, ABC Limited cannot maintain its books of accounts. So the question was, ABC Limited wanted to maintain its books of accounts on cash basis, that is whenever cash is paid or received. But the Companies Act makes it very clear that the books of accounts of every company registered under the Companies Act should be maintained on an accrual basis, that is as and when the transaction occurs, and double entry system, that is each transaction will have two entries, one is debit and one is credit. So no exception has been provided in the Companies Act from this requirement. That is why ABC Limited has to maintain its books of accounts on accrual basis and cannot maintain it on cash basis. Take a minute and read the slide, please. Now we come to an important topic. What do you mean by financial statements? Financial statement includes the cash flow statement, the profit and loss account or income and expenditure account, statement of change in equity if applicable, balance sheet, any explanatory notes annexed to or forming part of the financial statements. Now let's go through one by one. Now we've always heard this term, right? So far, that the company needs to prepare its accounts and financial statements. So the financial statement includes the cash flow statement. A cash flow statement is nothing else but a statement which gives the change in the cash position of a company from the previous balance sheet date to the next balance sheet date. That means if the cash balance on 31st March 2018 is 500 rupees and the cash balance on 31st March 2019 is 10,000 rupees. So that 9,500 difference between the 2 years, how it is moved, that means what are the sources of that cash and what are the payments of that cash. We need to explain that, and then we need to arrive at the 10,000 rupees closing cash balance as on 31st March 2019. There are various methods of preparing your cash flow statement. Accounting Standard 2 or Accounting Standard 3, deals with cash flow statement, and it talks about the direct method and the indirect method of preparing your cash flow statement. So a company to which a cash flow statement is applicable needs to prepare their cash flow statement as per Accounting Standard 3 cash flow statements, either using the direct method or indirect method of preparing the cash flow statement, and also that forms part of the financial statements of the company. A profit or loss account. A profit or loss account is nothing else but a statement that gives the results of a company during a period. The period could be from 1st April 2019 to 31st March 2020. That means during that period, how much of profit the company has made, how much of loss the company has made, what are the sales, what are the purchases, what are the salaries it's paid, what is the rent it's paid, what are the printing stationery it's paid, and what are the other incomes it has during a period. So a profit and loss account is a period statement. And now and an income and expenditure account. An income and expenditure account is normally prepared by a company which is not for profit. So in Companies Act 2013, it will be a Section 8 company, which is normally prepared to promote art, science, commerce, religion, education, caring for the society, and all that, and they do not work to make profit. So in their case, they will not prepare a profit and loss account, but they will prepare a income and expenditure account. And the end result will be excess of income over expenditure or excess of expenditure over income. It will not be called profit or loss because simply those entities do not carry out operations to earn profit or loss. Statement of change in equity. Now, statement of change in equity means the change in the equity share capital between one balance sheet date and the next balance sheet date. Just like your cash flow statement gives the change in cash position between one balance sheet date and the other balance sheet date, statement in change of equity gives the change in equity position or equity share capital of the company between one balance sheet date and the other balance sheet date. It is given in the term of reconciliation that the opening number of shares was so much, the closing number of shares was so much, and this is what the movement that happened in between. So many people gave up their shares, so many new shares were issued, so many shares were transferred, and etc. Balance sheet. A balance sheet contains the affairs of the company or the position of a company on a particular date. A balance sheet is known as a date statement, whereas a profit and loss or income and expenditure account is known as a period statement, because they give a results of the company for a particular period, whereas the balance sheet gives the situation of a company as on a particular date. That means as on 31st March 2020, how much of cash they have, how much of fixed assets they have, what is the share capital they have, what is the sundry creditors they have, what is the sundry debtors they have, and everything. So as on that date, what is the position of the company is given by the balance sheet. And then if there are any other notes or additional information needed to be given by a company, that forms part of notes to accounts, which are annexed to the financial statements. So your financial statements include cash flow statement, profit and loss account, statement of change in equity, balance sheet, any explanatory notes or notes to accounts. However, the financial statement with respect to one person company, small company and dormant company may not include cash flow statement. Financial statement should be prepared for financial year as per the requirements of Schedule 3. So the Companies Act 2013 exempts one person company, small company and dormant company from the requirement of cash flow statement, and also all the financial statements of a company should be prepared as per Schedule 3 of the Companies Act, which gives you the format in which the financial statements of a company should be prepared. Please take a minute, go through the slide, and then we proceed. Please go through this and then we proceed. Okay, now financial year. In relation to any company or body corporate means the period ending on 31st March of every year, and where it has been incorporated on or after the first date of January of a year, the period ending on 31st day of March of the following year, in respect whereof a financial statement of a company is made up. Now, for example, if a company starts on 1st June 2019, then the financial year of the company, the first financial year of the company will be from 1st June 2019 to 31st March 2020. The next year, the financial year of the company will be 1st April 2020 to 31st March 2021. So normally the financial year starts from the first day of April and ends with the 31st day of March of the next following year. Provided that on application made by the company or body corporate, which is a holding company or subsidiary company or associate company of a company incorporated outside India, and is required to follow a different financial year for consolidation of its accounts outside India, the tribunal may, if it's satisfied, allow any period in its financial year. Okay, now this is an important topic. You please listen. Now, a body corporate means the branch or subsidiary of a foreign company that is located in India. So that is a body corporate. Now, let's say a company is in the US. Now, in US, the financial year normally is 1st Jan and ends on 31st December. So let's say a US company starts a company in India, a branch or a subsidiary. So in that case, it becomes a body corporate, and for the purpose of preparing of accounts, the holding company in US will require the accounts of the subsidiary or branch company in order to prepare the combined accounts, correct? Consolidated accounts. So in that case, the body corporate which is situated in India may request the tribunal that please, for the purpose of consolidation of accounts outside India, please change my financial year from 1st Jan to 31st December. So if the tribunal thinks, okay, it's important and this thing, it may allow the company to change its financial year from 1st Jan to 31st December. But whenever it files its returns in India, income tax returns or any other returns in India, it will also have to prepare its accounts from 1st April 2000 something to 31st March 2000 something. The income tax will not give it any leeway, but the Companies Act may or may not give a flexibility, but again they'll have to prepare two sets of accounts. So the act will say, okay, you want to prepare it for US purposes, right? But for Indian income tax purposes, you need to prepare the 1st April to 31st March. So in that case, it will have to be done. Provided further that the company or body corporate existing on commencement of this act shall within 2 years from such commencement align its financial year as per the provisions of this clause. Now, if there was any body corporate which was using another financial year, that is 1st Jan to December, within 2 years of the Companies Act 2013 coming into the picture, will change its financial year from 1st April to 31st March. So it has to be constant. Please take 2 minutes, read the slide, and then we proceed. Take about 30 seconds more and then we proceed. True and fair. 1. The financial statement shall give a true and fair view of the affairs of the company or companies. It shall comply with the accounting standards notified under section 133 and shall be in the form of forms as may be provided for different class of companies in schedule 3. Like I told you, the financial statements of companies incorporated under the Companies Act will have to be prepared as per schedule 3 of the Companies Act, which gives you the format of the balance sheet and the profit and loss account, and your profit and loss account and balance sheet have to be exactly as per that format. And also there are accounting standards which are notified under section 133, so the company's account should comply with these accounting standards as well. These accounting standards have been prepared by the Institute of Chartered Accountants of India and have been notified by the Companies Act under section 133. So while preparing the accounts of companies, you need to the one company needs to follow the schedule 3 of the Companies Act as well as the accounting standards as notified under section 133. There are about 29 accounting standards, and whatever is applicable to that company, the company needs to follow that and adhere to those accounting standards. Non-applicability. Provided further that nothing contained in this subsection shall apply to any insurance or banking company or any company engaged in the supply of electricity or any other class of companies from which a form financial statement has been specified in or under the act governing. Like I mentioned in my first session on incorporation of companies, that is the applicability of Companies Act 2013. The Companies Act 2013 is applicable to all companies incorporated under the Companies Act except banking companies to which there is a law applicable, that is the Banking Regulation Act, electricity companies to which there is an Electricity Act applicable, insurance companies to which the IRDA and the Insurance Act is applicable, and any other company to which a special act is applicable. In that case, they need to follow those provisions, And where those acts are silent about any provisions, then they need to follow the Companies Act 2013. Similarly, the Companies Act in terms of maintenance of accounts will not apply to them, because if their respective act talks about a format about in which the accounts need to be prepared, then those companies are required to prepare the accounts in that format only. Laying of financial statements. At every annual general meeting of the company, the board of directors of the company shall lay before such meeting financial statements for the financial year. Like I told you, every company is supposed to hold its annual general meeting within 6 months from the end of the financial year, and in that annual general meeting, it will lay, the board of directors of the company shall lay before the shareholders the accounts of the companies, as well as the audit report, as well as the board's report, which we will see further. Please take about 2 minutes, go through this slide, and then we proceed. Take 2 minutes and then we proceed. Ask me any questions you have. Take another minute, go through this. Okay, consolidation of financial statements. Where a company has one or more subsidiaries or associate companies, it shall, in addition to financial statements provided under subsection 2, prepare a consolidated financial statement of the company and of all the subsidiaries and associate companies, in the same form and manner as that of its own and in accordance with applicable accounting standards, which shall also be laid before the annual general meeting of the company, along with laying of the financial statement under section 2. Now, what does this mean? Let's say a company has a holding company. It has a holding company in India. It has a let's say the company has a subsidiary company in India and it has a subsidiary company abroad, the US. So the Companies Act says that in the annual general meeting, it shall lay before the members not only the standalone financial statements, that is balance sheet, cash flow, profit or loss account, and notes to accounts, but also the consolidated. That means the combined accounts of all the subsidiaries and associate companies put together all over the world. Also, you will have to place it in the annual general meeting of the company before the members. So for this, it is very important that all the accounts of all the subsidiaries and associate companies should also be in the same format as that of the main company. So care has to be taken. If those are subsidiaries in another country, then those financial statements first have to be converted into the Indian GAAP financial statements using the Indian accounting standards and the Companies Act, and then they need to be merged or consolidated with the standalone financial statements. So let's say a company has subsidiary companies in 10 different countries, then all the financial statements of all those countries will have to be first made or changed into financial statements in India using the Companies Act and accounting standards, and then they will have to be merged with the standalone financial statements of the holding company to form a consolidated financial statement. So in the AGM, there will be a standalone financial statement and there will also be a consolidated financial statement containing the combined results of all the associate and subsidiary companies of the company all over the world and presented to the shareholders. Okay, manner of consolidation of accounts. The consolidation of financial statements of the company shall be made in provisions of Schedule 3 of the Act and applicable accounting standards. Again, the consolidation of accounts will also be made as per the provisions of Schedule 3 of the Act and applicable accounting standards. In case the company is not required to prepare cash flow statement. Consolidated financial statements. A company covered under subsection 3 of section 129, which is not required to prepare consolidated financial statements under the accounting standards. It shall be sufficient if the company complies with the provision of consolidated financial statements provided in Schedule 3 of the Act. So, accounting standard deals with consolidation of accounts, and if in case any company does not have consolidation of accounts applicable to it, then it can follow the provisions as given in Schedule 3 of the Companies Act. Right? So please take about 2 minutes, go through the slide in detail and ask me any questions you have. Take about a minute more. Okay, penal provisions. If a company contravenes the provision of this section, the managing director, the whole-time director in charge of finance, the chief financial officer, or any other person charged by the board with the duty of complying with the requirements of this section, and in the absence of any of the officers mentioned above, all the directors of the company shall be punishable with an imprisonment for a term which may extend to 1 year, or with fine which may not be less than 50,000 rupees, or which may extend to 1 lakh or 5 lakh rupees. So in case the company does not follow or comply with the provisions of the Companies Act, every person of the company in charge with finance, that may be the director in charge of finance, the chief financial officer, the managing director, or any other person authorized to be in charge, shall be liable for punishment which may extend to 1 year or 50,000 rupees penalty, which may be extended to 5 lakhs or 1 lakh or 1 year imprisonment, or both. Okay, so this will be the penalty provisions in case the provisions of the Companies Act are not complied with. The next topic, reopening of accounts on courts, tribunal orders. This section seeks to provide for reopening of books of accounts and recasting its financial statements. Apply to court for reopening of accounts. A company shall not reopen its books of accounts and not recast its financial statements unless an application in this regard is made by the central government, the state, the income tax authorities, SEBI, or any other statutory bodies. Okay, which simply means that once the books of accounts of a company are prepared and audited and closed, those books of accounts shall not be reopened or recasted unless and until an application is in this regard is made by the central government, the income tax authorities, SEBI, which administer listed companies, and any other statutory regulatory body which may require it to be done. So unless an application is made by these bodies, the accounts of a company will not be allowed to be reopened or recast. Okay, so to the effect that the relevant earlier accounts were prepared in a fraudulent manner, or the affairs of the company were mismanaged during the relevant period, casting a doubt on the reliability of the financial statements. So only in case where the central government, the income tax authorities, the Securities Exchange and Board of India and other regulatory authority can prove with reasonable effect that the relevant accounts of the previous years were prepared in a fraudulent manner, or the affairs of the company were mismanaged during the relevant period. In that case, they can make an application for reopening and recast of those books of accounts. Now, one prime example what you could think of was the Satyam case, in case you remember it. There were huge mismanagement and fraudulent activities that took place in Satyam at that point, right? And there were huge crores of rupees that were unreported or misreported, and I think even the auditors were involved. So in that case, if 1 year we have found that there is something fraudulent, so because of that 1 year's transactions, the central government or the income tax authorities or SEBI may ask for the previous year books of accounts also to be opened and recast, because 1 year was found to be in a fraudulent manner. So there is every chance that the previous year accounts also would be in a fraudulent manner. Please take 2 minutes and read this slide, and then we proceed. Take about a minute more, go through this. Take another minute. Okay. Serving of notice. Provided that the court or the tribunal, as the case may be, shall give notice to the central government, the income tax authorities, the SEBI, and any other statutory body or authority concerned, or any other person concerned, and take into consideration the representations, if any, made by the government or the authorities, SEBI, or any other concerned any person before passing an order. So, the court or the tribunal, once the central government, the income tax authorities, or the SEBI or the other authority makes an application to the court or tribunal that they want the earlier accounts to be opened and recast, then the court or the tribunal, as the case may be, will give them an opportunity to be heard. And after the representation and submissions by the central government, the income tax authorities, SEBI, and the other authorities, it will pass an order that accordingly, which it deems fit. Revised account shall be final. The account so revised or recasted shall be final. So then the court might call upon all the information it wants and everything, and based on that it might say, okay, I allow the accounts to be opened and revised, and then it will appoint a consultant or an accountant or an auditor to do the whole work. And then once the accounts are so revised and recasted, those will be final, and no further changes in those will be allowed. This is a prime case or example of Satyam that happened. Time limit in respect of reopening of books of accounts. No order shall be made under subsection 1 in respect of reopening of books of accounts relating to a period earlier than 8 years 8 years immediately preceding the current financial year, provided that the direction has been issued by the central government under the provision of section 5 of 128 for keeping the books of accounts for a period longer than 8 years. The books of accounts may be ordered. Okay, now in our previous slides we read, right, that the maximum period for which the books of accounts need to be kept are for 8 years immediately preceding the relevant financial year. So even the case of opening of those books of accounts and recasting of those books of accounts cannot be done for a period of before 8 years than the preceding previous year, as the books of accounts will not be there by then, as a company is not required to keep a books of accounts. However, if the central government has ordered that a particular company needs to keep books of accounts for more than 8 years, in that case it can be done, but otherwise it cannot be done, because you're not supposed to keep the books of accounts for more than 8 years prior to the relevant previous year. So if the books of accounts are not there, it cannot be reopened or recast. Please take 2 minutes, go through the slide, and then we proceed. Take another minute, go through this. Okay. Voluntary revision of financial statements or board's report. Preparation of revised financial statements or revised report on the approval of tribunal. If it appears to the directors of a company that the financial statements of the company, that is the balance sheet, profit and loss, cash flow statement, statement of change in equity, and the notes to accounts do not comply, and the board report, directors report, do not comply with the provisions of section 129 or section 134, they may prepare revised financial statements or revised report in respect of any of the 3 preceding financial years after obtaining approval from the tribunal or an application made by the company in such form and manner as may be prescribed, and the copy of the order passed by the tribunal shall be final with the registrar. So if whenever the board of directors think that the financial statements, that is the balance sheet, profit and loss account, and or the board directors report are not prepared as per section 29 or section 34 of the Companies Act, they may apply to the tribunal to prepare revised financial statements and revised reports thereon. The tribunal will give them a chance to be heard, and after taking in due representations from them will pass an order, and such order shall be filed with the registrar, and also the revised financial statements and revised reports shall be filed with the registrar of companies. Please take a minute, go through the slide. Take about a minute. Okay. Then the tribunal will serve a notice, provided that the tribunal shall give notice to the central government and the income tax authorities and shall take into consideration the representations, if any, made by the government or the authorities before passing an order in the section. Okay, so the directors felt that the financial statements of the company or the board's report was not prepared as per section 129 or 134, and hence they wanted to revise the financial statements and the report thereon. So they make an application to the tribunal. The tribunal may not outright accept or reject their application, but it will also tell the interested parties or the stakeholders that the company wants to do so and so, because please remember the financial statements and the reports thereon have been already filed and submitted with the ROC and the income tax authorities, and if now these need to be changed, then the income tax authorities and the other central government need to know about this. So the tribunal will send a notice to them saying that the company wants to do so and please give in your representations. After hearing the representations of the income tax authorities and the other authorities, the tribunal may pass an order. Number of times that revision and recast can be done, provided further that such revised financial statement or report shall not be prepared or filed more than once in a financial year. So you cannot revise or recast your numbers more than once in a financial year. So you cannot just revise your numbers whenever you feel like. It can be done only for once a year, that too with the approval of the tribunal and getting the representations from the income tax authority, central government, and the other authorities. Reasons for revisions to be disclosed, provided also that the detailed reasons for revision of such financial statement or report shall also be disclosed in the board report in the relevant financial year in which the revision is being made. Limit of revisions: where copies of the previous financial statement or report have been sent out to members or delivered to the registrar or laid before the company meeting, the revisions must be confined to. All right. So then the revision must be disclosed as to why the revision was made. The reason for it should be disclosed in the board's report, director's report, saying that the revision was done for so and so reason. Please take 2 minutes, go through the slide, and then we proceed. Okay, the number of revisions: where the copy of the accounts and the director's report and the audit report have already been circulated to the members and given to the ROC and laid before and given to the central government, then the revision must be confined to the correction in respect of which previous financial statement or report do not comply with the provisions of 129 or 134, the making of necessary consequential alteration. So only in these two situations should the reports and the financials be altered: when the necessary information as required under section 129 or 134 is not given, or the making of any consequential alternation is important, and it is very important to reflect the true and fair nature of the accounts. Only then an alteration will be allowed. Framing of rules by the central government in relation to financial statements or director's report. The central government may make rules as to the application of the provisions of this act in relation to revised financial statements or revised director's report, and such rules may in particular make different provisions according to which previous financial statements or reports are replaced or are supplemented by a document indicating the corrections to be made. Make provision with respect to the functions of the company's auditor in relation to revised or financial statement or report. Require the directors to take up such actions may be prescribed. So this simply means that the central government may always form rules and regulations where revised financial statements are to be made. That means the mode of revision that is need to be made, the provision relating to auditors where revised accounts need to be reported on, and require the auditors to take such steps as may be prescribed. Please take a minute, go through this slide, and then we proceed. Take a minute and then we proceed. Constitution of National Financial Reporting Authority. The central government may by notification constitute the National Financial Reporting Authority (NFRA) to provide for matters relating to accounting and auditing standards under this Act. Notwithstanding anything contained in any other law for time being enforced, the National Financial Reporting Authority shall make recommendations to the central government on the formation and laying down of accounting and auditing principles and standards for adoption by companies or class of companies or their auditors, monitor and enforce the compliance with accounting standards and auditing standards in such manner as may be prescribed, oversee the quality of service and of the professions associated with ensuring compliance with such standards, the suggested measures required for improvement in quality of service, and such other related matters as may be prescribed. So the central government may form a National Financial Reporting Authority for various purposes for matters relating to accounting and auditing standards. So what are the various reasons for which the National Financial Reporting Authority may be formed. It may be formed to make recommendations to the central government on the formulation of laying down new accounting and auditing policies and standards based on the requirements and the experiences that they are having with various companies and the auditors. The National Financial Reporting Authority may monitor and enforce the compliance with accounting standards and auditing standards in such manner as may be prescribed as to how many companies are following actually the accounting and auditing standards, what are the deviations being made, and if any deviations are being made, to report to the company that yes, you have not followed this accounting standard, whereas you needed to follow that accounting standard. Oversee the quality of service. The National Financial Reporting Authority may also oversee the service of the professionals associated, that is the chartered accountants, company secretaries, and cost accountants who work with companies to ensure that the accounting standards are being followed, the auditing standards are being followed, and the highest quality of service is being provided by these professionals to the companies. Please take 2 minutes, read the slide, and then we proceed. Please take about 2 minutes, read the slide, and let me know about the National Financial Reporting Authority. Take another minute. Okay. Then the NFRA also perform other functions as relating to clauses A and A, B, and C as may be prescribed. Then the composition of the National Financial Reporting Authority. The National Financial Reporting Authority shall consist of a chairperson who shall be the person of eminence and having expertise in accounting, knowledge, or auditing, finance, or other law to be appointed by the central government, and such are the members not exceeding 15, consisting of part-time and full-time members as may prescribe. So the NFRA shall be preceded by the chairman, who shall be a person of eminence in the accounting domain and accounting field, auditing field, and he shall be appointed by the central government, and other 15 members of the NFRA who will be part-time or full-time members as may be prescribed, we shall be appointed by the central government. Notwithstanding anything contained in any other law for time being enforced, the NFRA shall have the power to investigate either suo motu or with reference made to it by the central government or for such class bodies, body corporates or persons in such manner as may be prescribed into the matters of professional or other misconduct committed by the members or firm of chartered accountant registered under the Chartered Accountants Act 1949, having the same powers as vested in the civil code, namely the Code of Civil Procedure 1908, while trying a suit in respect of the following matters. So now we talk about the powers of the NFRA. The NFRA will have the powers to investigate, whether on itself or on a reference made to it by the central government, for such companies or classes of companies in such manner as may be prescribed into the matters of professional conduct by the chartered accountants or a firm of chartered accountants registered under the Chartered Accountants Act 1949, who are involved with the audit of the company. So the NFRA can investigate into matters, whether on its own if it appears to be, or on an application made by the central government that something is wrong with these companies appears, relating to the professional or other misconduct committed by the members of the firm. So please look into that matter. So in this case, then the NFRA will look into the matter, and the NFRA has the same powers as a civil court under the Code of Civil Procedure 1908 while trying a suit, which is discovery and production of books of accounts and other documents at such place and time as may be specified by the NFRA. So the NFRA can send a demand the discovery and production of books of accounts and other documents at such place and such time as may be specified by the NFRA. The NFRA might ask the company or the auditors or the chartered accountant to bring the books of accounts at such place and time as they want, summoning and enforcing the attendance of person and examination in oath. The NFRA can also summon and enforce the attendance of a person related with the issue and and examine them on oath that they will not lie and whatever they say will be the truth. Inspection of any books, registered, or other documents of any person referred to in clause B at any place. The NFRA also has the power to inspect any books, registers, or documents of any company or the firm of chartered accountants at any place, and issuing commissions for examination or witness of documents. Now, it could also ask for witnesses to be present in their premises in order to gain evidence on the case. Please take about a minute, go through the slide, and then we proceed. Central government to prescribe accounting standards. Section 133 of the Companies Act deals with the powers of the central government to prescribe accounting standards. The central government may prescribe the standards of accounting or addendum thereto as recommended by the Institute of Chartered Accountants of India in consultation with and after examination of the recommendations made by NFRA. So the central government, as per section 133 of the Companies Act, deals with the power of to prescribe accounting standards. The central government may prescribe accounting standard to different classes of companies under the Companies Act 2013, and also the powers to prescribe or new accounting standards in consultation with and recommendations of NFRA. Provided that until NFRA is constituted under section 132 of the Companies Act 2013, the central government may prescribe the standards of accounting or addendum thereto as recommended by the ICAI in consultation with and after examination of the recommendation made by the NACAS. So right now the NFRA is in the process of being made as per section 132. So until and unless the NFRA comes into existence, the central government may prescribe and formulate accounting standards in consultation with and recommendation of the Institute of Chartered Accountants of India and after recommendations made by NACAS. Please take a minute, go through this slide, and then we proceed. Take a minute. Financial Statement, Board's Report, etc. Section 134 of the Companies Act 2013 deals with financial statements as well as Board's report. The auditor's report is to be attached to every financial statement. A report by the Board of Directors containing details on the matters specified, including Director's responsibility statement, shall be attached to every financial statement laid before the company. The board's report and every annexure has to be duly signed. A signed copy of every financial statement shall be circulated, issued, or published along with all notices or documents, the auditor's report and board's report. So now we come to section 134. Section 134 deals with the financial statements as well as the board's report and also the auditor's report. The financial statement consists of the balance sheet, the profit and loss account, or the income and expenditure account, the cash flow statement, the statement of changes in equity, and the notes to accounts. So all of these form part of the financial statements. Then there is also the board's report. The board of directors are supposed to give a report along with the financial statements and auditor's report for each financial year, giving details about the operations of the company during that financial year. And it has to be attached to every financial statements duly signed by the board of directors. A signed copy of every financial statement shall be circulated. Okay, and all these, the financial statements, that is the balance sheet, profit and loss account, cash flow statement, statement of change in equity, as well as notes to accounts, shall be laid before the AGM of the company for each financial year within 6 months from the end of that financial year. And also your director's report as well as auditor's report will be laid in the same AGM for approval by the shareholders of the company. Authentication of financial statements, section 134, 1, 2, and 7. The financial statement, including consolidated financial statement, if any, shall be approved by the board of directors before they are signed on behalf of the board, at least by the chairman of the company, where he is authorized, or by the board, or by 2 directors, out of which one shall be the managing director and one shall be the chief executive officer if he is the director in the company, the chief financial officer, and the company secretary of the company wherever they are appointed, or the case of one person company, only by one director for submission to the auditor report thereon. So for each financial year, that is, for example, financial year 1st April 2019 to 31st March 2020, the financial statements for that particular year will be checked and will be first authenticated by the board of directors, or by at least 2 directors. One of them should be a managing director and the other should be a CEO if he is a director, or the CFO, or if the company has a company secretary, by them. And then only after attestation or authentication of these accounts can they be sent to the auditor for his report thereon. That means only then can the auditor start his work of checking those books of accounts and giving his opinion in the form of an audit report. So first, it has to be the financial statements have to be authenticated by the board of directors on behalf of the board. Okay, so please take about a minute, go through this slide, and then we proceed. Take another minute, go through this, then we proceed. Okay, the audit report shall be attached to every financial statement. Like I said, the auditor's report has to be attached to each financial statement, which is sent to the ROC as well as sent to the shareholders of the company. A signed copy of every financial statement, including consolidated financial statement, if any, shall be issued, circulated, or published, along with a copy each of the notes, the audit report, and the board's report. So the financial statements, that is your balance sheet, profit and loss account, notes to accounts, cash flow statement, and the statement of change in equity if applicable, for both standalone as well as consolidated, will be sent to will be circulated or sent along with the notes to accounts for each of those consolidated or standalone financial statements, the auditor's report, the auditor report for both the consolidated and the standalone report, and the board's report for both the audited consolidated financial statements as well as the standalone financial statements. So all these things will be circulated along with the financial statements. Board's report. According to rule of the Companies Account Rules 2014, the board's report shall be prepared based on a standalone financial statement of the company and shall report on the highlights of the performance of subsidiaries, associates, and joint ventures and their contribution to the overall performance of the company during that period. So a board's report, a director's report, will be prepared only for the standalone financial statements, And in that board's report, you will also mention about the performance of the various subsidiaries, associates, and joint ventures, and the overall performance of the company during that period. Please take a minute, go through this slide, and then we proceed. Take about a minute, then we proceed. There shall be attached to the statements laid before the company in general meeting a report by the board of directors. Like I said, the directors' report shall be attached to every financial statements, and it shall be laid before the company in the annual general meeting. Laid before the company means laid before the shareholders of the company, and it shall include the web address, if any, where annual return has been placed, number of meetings of the board. That means during that financial year, how many board meetings were held. Director's responsibility statement, a statement stating that the directors are responsible for certain matters, which we will discuss further. Details of fraud reported by the auditors. If the auditors have reported any fraud, the director's report will contain details thereon and explanation on those matters. A declaration by the directors. Company's policy on directors' appointment and remuneration. Comments by the board on remarks made by auditor and CS. So let's say the auditor in his audit report or the company secretary has made certain adverse comments or qualifications, then the director's report will contain remarks or comments on those qualifications. Particulars of loans, guarantees or investments, particulars of contracts or arrangements entered during that year, particulars of loans, guarantees or investments made during that year, state of company's affairs, whether the company is doing well as per expectations or below expectations, or how is the performance of the company. Amounts carrying reserves or paid by way of dividend, or whatever amount has been paid as dividend or whatever amount has been transferred to reserves, that will be mentioned in the director's report. Material change affecting financial position. If there is any change during the year that has happened, that is changing the financial, affecting the financial position of the company, that will be mentioned in the director's report. The steps taken for conservation of energy, technology absorption and foreign exchange in case it is applicable to the company. So whatever steps the company has taken for conservation of energy, technology absorption and foreign exchange during that year, it will report that in the director's report. Please take a minute, go through this, and then we proceed. Take about a minute and we continue. Abridged board's report. The central government may prescribe an abridged board's report for the purpose of compliance with this section by a one-person company or a small person company. Like the name says, if it's a one-person company or a small person company, then the central government may prescribe not a detailed board's report but a smaller version or a summarized board's report to contain only important information as may be prescribed. OPC or a small company is not required to give a detailed director's report. A board's report in case of OPC. In case of one-person company, the report of the board of directors shall be attached to the financial statement under this section shall mean a report containing explanation or comments by the board on every qualification, reservation or adverse remark or disclaimer made by the audit in the report. So in case of an OPC, The director's report will contain explanations only on matters which are given by the auditor of the company as adverse opinions or qualifications. If the auditor has given any adverse opinion or qualifications in his report, then the board's report will contain explanation or comments on that matter. Signing of the board's report and any annexure thereto shall be signed by its chairperson of the company if he is authorized by the board, and where he is not so authorized, shall be signed by at least 2 directors, one of whom shall be a managing director or the director where one is one director. So normally the director's report shall be signed by the chairman if he is so authorized by the board, or it should be signed by 2 directors if and one of them should be the managing director and the other should be a normal director. Please take a minute, go through the slide, and then we proceed. Okay. Then we have corporate social responsibility. The Companies Act 2013 lays down provisions requiring corporates to mandatorily spend a prescribed percentage of their profits on certain specified areas of social upliftment in discharge of their social responsibilities. Broadly, corporate social responsibility or CSR implies a concept whereby the companies decide to contribute to a better society and a cleaner environment, a concept whereby companies integrate social and other useful concerns in their business operations for the betterment of its stakeholders in general and society. So see, this concept of corporate social responsibility has been introduced by the Companies Act 2013. Please remember, corporates or big companies do not work in isolation. They work in a society. And when they work in a society, there are a lot of things they take from the society. So it becomes their moral responsibility to in turn give back to the society. And for this purpose, a corporate social responsibility or CSR provision was included in the Companies Act 2013, where certain companies are required to spend a specific performance of their profits on CSR activities. Let's know more about this. Corporate social responsibility. The company CSR policy rules 2014 provides the exhaustive definition of CSR, which provides that the CSR means and includes, but it is not limited to, projects or programs relating to activities, areas or subjects specified under Schedule 7 of the Act, projects or programs relating to activities undertaken by the board of directors of a company in pursuance to recommendations of the CSR committee of the board as per declared CSR policy of the company, subject to the condition that the policy includes activities, areas or subjects specified in Schedule 7 of the Act. So Schedule 7 of the Act identifies certain projects and activities which need to be done in order to comply with the CSR activities. So every company to which provision is applicable needs to comply with the activities or programs mentioned under Schedule 7 of the Act. Please take a minute, go through this slide, and then we proceed. I'll just get some water. All right. Which company is required to constitute a CSR committee? A company which has a net worth of rupees 500 crore or more, or the company has a turnover of rupees 1000 crore or more, or a net profit of rupees 5 crore or more during the immediate preceding financial year, shall constitute a corporate social responsibility committee of the board consisting of 3 or more directors, out of which at least one director shall be an independent director. So, which company shall constitute a CSR committee? A company which has a net worth. Net worth means the total of the paid up share capital and free reserves of the company and minus the debit balance in the profit and loss account. If it has a net worth of 500 crores or more, then in that case, or if the turnover of the company is 100 crores or more, or in the immediately preceding previous year, the company had a net profit of 5 crores or more. In that case, they need to constitute a CSR committee comprising of 3 directors, out of which at least one should be an independent director. Exclusion of companies. Every company which ceases to be a company covered under Section 1 of 135 of the Act for 3 consecutive financial years is not required to constitute a CSR committee. So, if any company does not fulfill any of the above 3 conditions, that is net worth, turnover and net profit, for a continuous period of 3 years, in that case, they do not need to constitute a CSR committee. Composition of CSR committee. The CSR committee shall be consisting of 3 or more directors, out of which at least one shall be an independent director. Please take a minute, go through this, and then we proceed. Go through this. Duties of the CSR committee. The CSR committee shall formulate and recommend to the board a CSR policy which shall indicate the activities to be taken by the board in areas or subject specified in Schedule 7. So the board will basically make sure that the company does those activities or projects as mentioned under Schedule 7 of the Companies Act 2013. Recommend the amount of expenditure to be incurred on the activities referred to in this clause. So the CSR committee will recommend or decide on the amount of expenditure that needs to be incurred on the CSR activities and monitor the CSR policy of the company from time to time to see that the company is following the CSR policy and not deviating from it. The contents of the CSR policy. List of CSR projects or programs which a company plans to undertake falling within the purview of Schedule 7, specifying modalities of execution of such project or programs and implementation schedules for the same, monitoring process of such projects or programs. Provided that the CSR activities do not include the activities undertaken in pursuance of normal course of the business of the company. Provided further that the board of directors shall ensure that activities included by a company in its CSR policy are related to the areas or subjects specified in Schedule 7 of the Act. So see, in all this you will notice that your CSR policy of the company should be made in line with Schedule 7 of the Act, and the committee monitors whether the policy is made so, whether it is functioning properly and whether there is any deviation, and also monitors the amount of expenditure required to comply with the CSR policy. Duties of the board in relation to CSR. After taking into account the recommendations made by the CSR committee, approve the CSR policy for the company and disclose the contents of such policy in its report and also place it in the company's website if any. Ensure that the activities as are included in the CSR policy of the company are undertaken by the company. The amount of contribution towards CSR. The board of every company shall ensure that the company spends in every financial year at least 2% of the average net profits of the company made during the immediately preceding 3 financial years in according to CSR policy. So the board has the body or the board has to ensure that the company spends at least 2% of the average net profits made during the 3 preceding previous years. Okay, provided that the company shall give preference to the local area and areas around it where it operates for spending the amount earmarked for CSR activities. Provided further that if the company fails to spend such amount, the board in its report shall specify such reasons for not spending the amount. So, such companies which have a net worth of more than 500 crores, a turnover of more than 1000 crores, or have a net profit of 5 crores or more are mandatorily required to spend at least 2% of the average net profits of the previous 3 years in CSR activities during the current previous year. In case it fails to do so, the board of directors shall have to mention the reason for doing so or not doing so in its report. Companies may build CSR capacities at their own personal level as well as implementation agencies through institutions with established track records of at least 3 financial years. But such CSR expenditure, including expenditure on administrative overhead, shall not exceed 5% of total CSR expenditure of the company in one financial year. CSR activities. Okay. The CSR activity shall be undertaken by the company as per its CSR policy, which is made as per Schedule 7 of the Companies Act 2013, as projects or programs or activities, excluding activities undertaken in the normal course of business. So all these CSR activities should not be the activities that it normally does as part of its business, but it should be an exclusive CSR activity. The board of the company may decide to undertake its CSR activities approved by the CSR committee through a company established under Section 8 of the Act, or a registered trust or a registered society established by the company either singly or along with another company, or a company established under Section 8 of the Act, or a registered trust or registered society established by the central government or state government as the case may be, or an entity established under an Act of Parliament. A company may also collaborate with other companies for undertaking projects or programs or CSR activities in such manner that the CSR committees of respective companies are in a position to report separately on such projects or programs in accordance with these rules. Subject to provisions contained under Section 135, the CSR projects or programs or activities undertaken in India only shall amount to CSR expenditure. So if any CSR activity is undertaken outside India, it shall not constitute to be included in that 2% expenditure. The CSR projects or programs or activities that benefit only the employees of the company and their families shall not be considered as CSR activities. So basically the CSR activities should benefit or contribute to the society as whole and not only to the employees and their families. Then it will not be constituted as CSR activities. Companies may build CSR capacities of their own personal as well as those implementing agencies through institutions with well-established track records of at least 3 financial years, but such expenditure, including expenditure on administrative overhead, shall not exceed 5% of the total CSR expenditure of the company in one financial year. Contribution of any amount directly or indirectly to any political party under Section 182 of the Act shall not be considered as CSR activity. So any contribution to any political party shall not be considered as CSR activity. Copy of financial statements to be filed with the registrar. Copies of financial statement, including consolidated financial statements, if any, along with all the documents annexed to the financial statement and adopted at the AGM, shall be filed with the registrar. So that means your balance sheet, profit and loss, cash flow statements, change in equity, notes to accounts, along with the director's report and the auditor's report shall be submitted to the registrar within 30 days of the AGM. A copy of the financial statements, including consolidated statements, if any, along with documents which are required to or attached to such financial statements under the Act, duly adopted at the AGM, shall be filed with the registrar within 30 days of the date of AGM in such manner, with such fees or additional fees as may be prescribed. Where the AGM of a company for any year has not been held, the financial statements along with the documents required to be attached, duly signed with the statement of facts and reasons for not holding the AGM, shall be filed with the registrar within 30 days of the last date before which the AGM should have been held in such manner. So in case an AGM is held, then within 30 days of the AGM, the balance sheet, P&L, cash flow statement, notes to accounts and state changes in equity, along with director's report and auditor's report, shall be filed with the registrar of companies. Now, just in case the AGM has not been held within 30 days, in such a case, a statement as to the reasons as to why the AGM is not held, along with the financial statements and consolidated and standalone, as well as the director's report and auditor's report, shall be filed with the registrar within 30 days of the date on which the AGM was supposed to be held. Also, a statement saying the reason why the AGM was not held. So with this, I come to the end of the session on accounts of companies. in the Let's Crack CA Exams program vertical of Unacademy, India's largest online learning platform. I thank you very much for being a great audience. Do not forget to use the code Prathik when you make your subscription choice of 1 month, 3 months, 6 months, or 12 months, or 24 months as the case may be, to get a discount of 10% on your listed price. And I would like to bring your attention to the Plus program of Unacademy. The Plus platform, that is a subscription-based plan of Unacademy, gives you daily live classes where you get to chat with your educator, engage in discussion, ask your doubts, and answer polls all while the class is going on. You also get to attend live tests and quizzes which evaluate your preparation with regular mock tests and quizzes, and get detailed analysis on your performance so that you know your weak areas, your strong areas, and the areas where you need to pay more attention, and the areas where you need to spend lesser time, so that that time can be used on your weak areas. The courses provided by Unacademy are structured courses. They are structured in such a way that they are in line with your exam syllabus, and it ensures that you do not miss any important part of your syllabus while preparing for these exams. And lastly, and most importantly, it gives you unlimited access to all the live and recorded courses to watch from in the world of courses, contents, and resources of Unacademy. And all this at the comfort of your devices, at the comfort of your house, or while you're on the move. And you can just log into your mobile phones and use this opportunity to access all the valuable information that you need. For those of you who have downloaded and are using the Unacademy Learning app, I thank you very much for your continued support. And for those of you who have not yet downloaded the Unacademy Learning app, I request you to download the Unacademy app and register on it using your mobile number, on which you get an OTP. It's quite an easy process. And once you register, you carry the world of Unacademy and its resources, courses, and content in your pocket to access it anywhere at any time, which is at your fingertips and as per your convenience. The Plus program of Unacademy is a subscription-based program, and the CA Foundation and Intermediate package in the Plus program of Unacademy contains the following packages. It is for 1 month, 3 months, 6 months, 12 months, and 24 months. The 1 month package costs you about 3,500. The 3 months package costs you about 8,750. The 6 month package costs you about 14,000 rupees. The 12 months package costs you about 17,500, and the 24 months package costs you about 21,000. While you're making a choice for the package, please do not forget to use the code Prathik, Prathik, to get a discount of 10% on the listed price. So after discount, the price will be: the 1 month package will cost you rupees 3,150. The 3 months package will cost you rupees 7,875. The 6 month package will cost you rupees 12,600. The 12 month package will cost you rupees 15,750. The 24 months package will cost you about 18,900. While you are free to choose the package that you want, I would personally recommend you to go for the 12 month or 24 months package for 2 reasons. One is it is cost effective. If you see the difference of prices, it's not much, but you're getting a longer duration. And the second reason being, when you prepare for the CA examinations, which are a professional examination, you normally require a period of 1 year to 2 years to prepare. And in this package, you're getting the CA Foundation as well as the CA Intermediate subscription. So it will do justice to you, because you will be studying for at least a year for both these exams. So please do not forget to use the code Prathik, Prathik, to get a discount of 10% on the listed price. And I hope you make use of this opportunity and benefit from the same. For the people who have not followed me on the Unacademy app yet, I request you to go to the Unacademy app, go to my profile, Prathik Gupta, and click on the follow button to get live real-time updates on the date, time, and topic of the sessions that I'm going to take, so that you can be on time for my sessions and benefit from the same. I have taken sessions on various subjects and topics on YouTube and the Unacademy platform. I request you to access and go through these sessions and let me know of any feedback. Thank you so much for being a lovely audience, and I look forward to seeing you all once again. Thank you.